To really understand it, though, if you go back to the concept of the hog cycle in economics, so the concept of the hog cycle is you can imagine lots and lots of farmers who are growing pigs. None of them talk to each other because they're all miles apart from each other, but they all get affected by the same economic variable. And that basic variable is the price of meat at the market when they go and sell their pigs. So one year, one farmer goes to the market, tries to sell his pigs. He gets a really good price for his pigs, more than he expected. So he goes back home, tells his wife, and they say, right, well, we better grow some more pigs. You know, we're making money out of these things, so let's make a few more pigs. And of course, this is happening in every farm, you know, in
Farms
every
all across the
conversation.
countryside.
Yeah. So 2 years later, there's a hell of a lot more pigs being supplied to the market because everybody's been growing them. So in the market that year, there's a massive oversupply of pigs. The price starts collapsing. The price collapses. The farmers all go back home and they say, look, the price of meat has collapsed. The last thing we should be doing is growing more pigs. So they turn off the supply machine, stop producing pigs. 2 years later, they go back to the market. There's no meat. There's a massive supply shortage of meat. The price goes way high. All the farmers go back home again and start growing more hogs. So the hog cycle is characterized by always too many pigs or always too few pigs. There's never the right amount. And because the farmers don't talk to each other and they don't therefore maximize the efficiency of the market, there's always this inefficiency built into the market. Now, the theory that I've come to believe is that office developers are exactly the same as farmers producing hogs. Okay.
Well, okay, that's nice of you not to compare him to the hog itself. You're at least
No,
planting the
that's
farmer illusion.
no, that's the investment bankers. Anyway, so the developer goes back home to his board and he observes rising rents and he says, well, now it's economic to build, so let's build. Let's bring out this development that we've had on hold for a couple of years. It's now economic to build it. And of course, every other developer is feeling the same pressure, so they all go out and build. And of course, when they all go out and build, you know, they hits the market at the same time, whatever economic conditions might be, and there's a 1/3 chance that it's strong, 1/3 that it's normal, and 1/3 that it's weak. So there's a 2/3 chance it's not incredibly strong. There's an oversupply of office space, rents come down, and they stop building. And in fact, in every 15 years or so, they have such a horrendous experience because it coincides with bad economic circumstances. They lose so much money through this overdevelopment that they just don't do any more development for a long time. And you might be talking about 8 years, you know, where they're out of the market, which amplifies this thing even more.
Right.
And the game theory comes in because if the developers all got together and discussed this with each other, then they would end up with a more efficient solution whereby they'd all make normal profit. But because they don't talk to each other, they all go stumbling into this disaster from time to time. We've had a really good example of this very recently in the UK because following Brexit, we'd had a strengthening market and a supply shortage of office developments, and we were getting ready for a supply boom in offices, which we were all thinking was going to come about 2020.
Right.
Brexit meant that a lot of people are now thinking about that again. Now, one possibility, and we don't know what's going to happen, which makes it interesting. Either all the developers will go home and switch off the schemes, in which case we're going to end up with really good rents in the UK, or they're all going to say, no, I think my scheme will succeed because everybody else is going to switch theirs off, in which case, you know, everybody thinks the same way, and we still end up with a development glut. So we're in a very interesting situation. It's a classic example of the potential real estate cycle. The cycle is then amplified by the action of financiers. So if you think of finance as being equity and debt,
right?
If looking at debt first, if banks have lent a lot of money to developers who then lose a lot of money, then the banks lose their appetite for lending. And so the reduced appetite amongst the developers to build is matched by a reduced appetite amongst the banks to lend, and you end up with a real shortage of supply, and then you get this hike in rents. And equally, if you have a very good run, when prices keep going up, then bankers tend to lend more and more and more. No developer ever turned down a bank loan. I'm not sure whether that's a Graskamp phrase or not, but I've certainly heard it.
Sure.
You know, in the US.
Right.
And so you get this amplitude getting increasing until you get the disaster scenario again. And then again from equity, equity tends to invest too long into an uptick until it gets burned, and then it sort of gets
Right.
scared and goes away again.
I was talking to someone recently on a different episode, and he said if people knew where we were in the cycle, there wouldn't be a cycle. And I guess I understood his point, but I also thought, well, the nature of huge capital coming into the market sometimes just pushes down the returns you expect. I mean, I know Chinese investors who have a $500,000 apartment in Beijing and get $500 a month in rent from it would be content for many years if they were able to just push that capital all into Arizona, because regardless of how low the returns went, it would not be as low as what they had in Beijing.
Absolutely. I mean, this goes back to game theory again, and I wish I could remember Nash. This is Nash equilibrium again. It goes back to this point. I mean, your friend who said if people knew where they were in the cycle, they wouldn't be a cycle, is plainly wrong, because we may know that we're approaching high rents, but if there's still a massive shortage of office space, then you've got a chance of building the one development, the one skyscraper that's going to let for the record rent, because there's a shortage of space. Even though the record rent has already been achieved, why wouldn't your skyscraper make an even higher rent when there's a shortage of space?
Yeah.
So every individual developer, maximizes his economic return by doing this thing. But the problem is when they all do it together, then you end up with a suboptimal solution. So I think your friend's analysis is wrong, because people just don't talk to each other.
So if CBRE somehow had a way to look at medieval Manchester and, cap rates and so on, would you expect to find cycles that are very similar to the ones that we experience, or are there uniquely modern aspects of building a 90-story building that just takes longer than it would have, or the kind of credit that people get thrown at them that make this cycle more a uniquely modern phenomenon?
No, I think that's a really great question. And I suspect that if we went back to Manchester in medieval times, would have exactly the same thing. I don't think there is anything new. I mean, all that's new is that every time we have a cycle, there is a new paradigm, but there's always a new paradigm. And I mean, right now we have a tremendous example of this. We have rock bottom interest rates. So we may be approaching the top of a cycle in traditional terms, because rents are getting pretty high and cap rates are getting very low, and values per square foot are now huge and higher than they've ever been. But because the returns on alternative assets, bonds, cash, so terribly low, then and because of quantitative easing, because there's money being pushed into the economy, bonds being taken out of the market, then real estate looks like an interesting investment, even at very low cap rates, very high prices. So that's yet another new paradigm, which means that although we're at the top, we could go even higher. And there's always a new paradigm. I mean, so be careful of new paradigms, but don't assume that this cycle is just a predictable, repetitive 8-year thing with a known top and a known bottom.
Or 17-year, right? Isn't that there was something in the book about the potential superstitious 17-year, max cycle?
We have a beautiful cycle in the UK. We had 2007, 1990, 1973. You go back 17 years before that, you get to 1956, which was the last recession in the UK before the 70s. And Russia invaded Hungary and all that sort of stuff. And then 17 years before that was 1939, which was not
so all bets for 2024 are off. Nobody.
Absolutely. That's the time, exactly, clearly, if you believe in astrology.
Right.
Yeah.
One of the things that maybe I understood earliest about the cycles was things get out of control, goes back to the bank. Bank is not legally allowed to hold it and doesn't really want to. They have to sell it and get out. Somebody gets a bargain, but many people at that time are too credit strapped to get the bargain. One of the things that's very interesting is this question of the knife's edge moment, where foreclosures have not started, but everyone senses that paying 1 shilling more for this building would not be a wise investment. But there's no bargains on the market yet. Once the crash starts and people are doing workouts to get out of loans and there are bargains to be had, really once the crash is upon you, you've kind of started over, and in certain sectors of the market there are opportunity. But it's that awful period where you sense that you're at peak and no one wants to move. But there hasn't been a crash yet, which is what I'm concerned I'm going to face in about 12 months when I graduate.
Yeah. I can see your point. We're almost grateful for Brexit over here because it almost sort of took the pressure out of our market. We'd got a face-off between buyers and sellers that had been going on for over a year,
Right.
where everybody clearly thought that prices were a bit high. Buyers thought prices are a bit high, and sellers thought, well, I'm not going to sell for less than I could have got a year ago.
Yeah.
We had a bit of a strike, and Brexit seems to have cleared the market a little bit. It's probably taken a bit off the price, so it's made people feel just a little bit better about the market. When I talk to property investors, property fund managers, it's very, very rare indeed. In fact, I'm not sure I can ever remember a time when they say this is a really good time to buy.
Right.
I'm piling in, because even in 1991 in Texas and in 2009 in London, when prices dropped 40%, people were feeling hurt. They were really struggling,
Right.
and they'd got no access to debt. Their equity
Of
had been
course, yeah.
burned.
Like
They
a
were
parable, the best time to buy, and there's not a dollar to borrow.
absolutely. Now that there were some rational investors out there who did very well, but have you heard of the difference between a rational investor and an adaptive investor? It's not a joke, I'm afraid, Ben. It's just a boring economic analogy, but
Lay it
a-
on me, yeah.
adaptive expectations is characterized by people who use the present tense in association with investment. And I tell my MBA students, you never ever use the present tense in investment. So don't tell me the dollar is falling. Don't tell me the stock market is going up. Don't tell me house prices are rising, because all you can say is that they have risen.
Right.
Right? You might then make a judgment and say they will rise, but you
Mhm.
can't. The present tense, which connects the past with the future, is banned. You can't use it. The people who use it are adaptive expectations people.
Right.
So if something has fallen, you extrapolate that continued fall downwards. In crises, in great buying opportunities like 2009, 1991 in the US, adaptive expectations tends to trump rational expectations. So people don't pile in and make these great buys because they're hurting and they're using the present tense. The market is
Right.
weakening.
When you're assessing things in different points of the cycle, the main tool probably that's used, at least in a commercial context, are cap rates, capitalization rates. In the book, you were talking about predicting cap rates, and of course, that's the real trick. And there's this idea of building a cap rate with the risk-free rate plus the expected inflation, because you want it to be an inflation hedge, plus the risk premium, which is broken out into several things, minus the expected rent growth, minus depreciation. The risk premium is the tenant risk, the lease risk, the building class risk, and the location risk. Very sophisticated dissection. Once we have it broken out into these categories, and the risk-free rate is fairly straightforward, we can probably, with some success, talk about expected inflation. But things like the risk premium or the expected rent growth, in some sense, it puts the question just back at an earlier regress of the same question, right? In solving those. So how do you advise them about dialing in those things, which also, for me, I'm like, well, what is the risk premium, and how do I determine it for this building?
I'm not sure I'm grateful for that particular question, but there's a simple answer and there's a complicated answer. The simple answer is me with my teaching hat on, and the
Right.
complicated answer is me with my consultancy hat on. In the classroom, I'd make it as simple as I possibly can, and The cap rate should be the risk-free rate plus a risk premium minus rental growth, and you can make that really pretty simple because it's basically the bond yield plus a risk premium minus the rate at which rents grow up. Now, rents have gone up in the UK at exactly the rate of inflation over the last 35 years. All we need then is the bond yield plus a risk premium minus inflation. This is the simple approach, right? It's not my consulting approach because rental growth could be something other than inflation in the short term, and it's going to vary from market to market.
Right.
But right now, just take it's the 10-year Treasury plus a risk premium minus inflation. That's the cap rate you should be getting. So in the US right now, 10-year Treasury's at 1.5, 2. Let's say 2. Inflation, let's say 2.
Right.
So the cap rate is the risk premium. Okay. So if your bond yield's 2, your rental growth rate's 2, the cap rate is simply the risk premium. Now, if you're getting a cap rate of 4% for a really high quality piece of real estate, you're getting a 4% risk premium. How do you know whether that makes any sense or not? The only way you can really work out whether it makes any sense is to get a load of investors into a room and ask them. So you get a load of property investors, and you ask them what the IRR is that they want when they're buying a portfolio of assets, or just one or two good assets. And if they all say they want a 4% IRR or a 6% IRR, you can back that out. So the risk-free rate is 2. If they want a 6% IRR, they want a 4% risk premium for real estate. How are they going to get a 4% risk premium? Well, we've just solved that. It's a 4% cap rate and 2% growth.
Right.
Okay.
Right.
So it all fits together beautifully and simply. Okay. Now, better academics than me will give you all sorts of complicated ways of thinking about risk premiums based on CAPM and asset pricing models, and I can sell you econometric models that forecast rental growth, and I sell people that model, but that complicates things in the short term. The basic model is simply the one I offered you.